investment real estate seminar. I am here with a couple of my team members and also a really great attorney who is local in the area of Sarasota, Manatee County. Today we have a guest. His name is Ryan Featherstone. He's going to lead with some advice on why it's really important when you're investing in residential real estate, also maybe some commercial if you want to dabble in that, why it's so important to use an attorney. We always use an attorney. Ryan is our go-to guy for my personal investments. And of course, we always have a list of great experts that we refer to our clients. Ryan happens to be one of those attorneys. So welcome to our seminar, Ryan. And what's the best advice you can give us kind of in a nutshell from an attorney's perspective when they are looking to purchase residential property?
Well, thank you for having me. Yes, my name is Ryan Featherstone. I'm an attorney in Sarasota, Florida. I'm with the law firm of Dunlap and Moran. I've been practicing about 15 years with the same firm, born and raised in Sarasota. The firm, we have a couple offices in the area. I personally focus my practice on real estate transactional and business transactional law. On the real estate side, that encompasses closings of residential and commercial properties and everything underneath that umbrella. Contracts, leases, setting up business entities. And that's obviously very important sort of collateral work to investing because of when you're Mr. and Mrs. Smith buying your forever home or your residence, you don't really have to think about that. Obviously, you're going to purchase the property in your individual name. You're going to apply for your homestead. You're going to do all the things that say, this is my home, this is my residence, etc. Now, if you're an investor, it's a little different. How you take title is crucial. Are you going to set up an LLC or a corporation for whether it might be liability, tax purposes, or both? So that's one consideration that is something to be aware of when either investing yourself or dealing with investors. They're going to be talking, especially sophisticated investor clients. They're going to be talking about that. How should I take title? What do you recommend? Should I set up a single asset LLC? Do you already have an LLC that is funded by 3 or 4 other properties? Is it time to open up a new LLC? That's a important topic to cover. And that's also relevant for tax purposes. I said leases before. Is the property going to be leased out? Is that the purpose of it, or is it a fix and flip? Or if you're going to lease it, should you have an LLC or corporation vested in title so that there is that shield of protection if there's a slip and fall on the property, the tenant injures himself, he has his family members or friends over there and they hurt themselves, something catastrophic happens on the property, they're going to be looking to that deep pocket of that investor from their individual investor. The investor needs to be shielded from that potential liability, and a business entity is one of the cheapest, least cumbersome ways to avoid that liability and protect themselves. With that, a sort of a collateral issue to that is insurance. What insurance rates are you looking at as an investor? You're certainly going to be paying more on the insurance side than you would if it was your primary residence. LLC, corporate ownership policies for investment properties are typically higher than it would be for Mr. and Mrs. Smith buying their primary residence. Mortgages, same thing. Are you paying cash? Do you have a pool of investors that are pulling their money together and buying properties together, or just an individual investor who has cash to buy properties, or are they looking for financing? Financing options are very different than your Mr. and Mrs. Smith buying their primary residences. You traditionally have your primary residence mortgage, your second home mortgage, and then your investment property. The rates go up as you go down that scale, and the costs also go up. So your investment property loans tend to be higher interest rates, higher closing costs, riskier to lenders, and they know that, so they incorporate that into the rates and the costs. So that's just some of the stuff that's off the top of my head about that. Now, from a closing agent standpoint, who is also an attorney, because we're a law firm. We handle a
Hmm.
lot of closings, as Brandy knows. We do what a title company does, but we do more than that. We're not just issuing
You
title.
do way more, and I'm not trying to say one's better than the other. We just have a great experience with your particular law firm in many instances. So I'm not going to say you have to use an attorney or you have to use a title company. It's not my choice. I can just share my experiences, and I'm not trying to, put you up on a pedestal here or anything. But you are so appreciated by our team and by our clients because you do so much more and go above and beyond to where that trust factor is something that will never be able to be breached right now. I just feel every transaction, we feel you have our client's best interests in mind when you're representing our client.
Well, thank you very much. I really appreciate that. That's very kind words, and the feeling is more than mutual with you, Brandy, and your whole team. Um, you're exactly right. I mean, we bring in a matter. We represent the buyer or the seller. They're our client. Your client, you bring to us, and they're our client. We're not a neutral third party like a title company legally has to be. We get that question all the time. Oh, I thought you were neutral. We can't be. Ethically speaking, ethics rules of the Florida bar, we have to have a client. If you bring the client to us, they're our client, just like they're your client. And we're looking out for them. And, a nice side benefit of that is we're really looking out for you.
Yeah.
If there's something on title or a survey defect or something like that that we catch that needs to be resolved, it's like I say all the time. If you close something wrong with title or a property, it usually doesn't come up the day after closing. It's 5 years down the road, 10 years down
Right.
the road. When that client goes to refinance or sell the property, that's when the issue is discovered. Whoever closed it, if it's title company, whatever, you can try to go back to them for a resource of, whether it's a title insurance policy, whatever. Many times that company's out of business. So
Right.
there's, often a lack of avenue of recourse there. So yeah, title things typically don't rear their ugly heads if there's a defect in that closing until much later after closing. It's never right away.
Yeah.
But you're absolutely right. I mean, our we're an advocate for our clients, and we'll fight for them, and we point out issues. We're certainly not here to over lawyer. We have enough experience to know major issues versus minor issues and different options of resolving issues. But our focus is just to make sure that you guys are covered, that the client is covered. If it's an investor, obviously that the investor is covered. But from the title insurance perspective, there's a lot of different investing opportunities out there. You've got REO bank-owned properties. You still got a few short sales out there. You have foreclosed properties that you can buy at auction. You've got Hubzu. You've got all these different things
Yeah.
that are going on. But at the end of the day, however the auction platform is, or however the owner of the property took title, um, it's all the same. You've got due diligence that you need to do. It's not just the physical nature of the property. It's what's going on, behind the curtain. What's on that title that might come to bite the buyer, investor, whoever, after closing? Are there liens that no one knows about that aren't discovered? If it's a bank-owned property, they don't know anything about the property. They say that out front. They're like, look, we're a bank. We
Yeah.
foreclosed. We
It's
don't know.
as is. We don't have a clue.
We don't have a clue. Don't look to us for anything. We're not going to give you a seller's disclosure. We don't know a thing about this property. We took it through foreclosure. Hey, buyer beware. You
Buyer
go through
beware.
diligence. So we get a lot of phone calls about, like, for example, foreclosed properties where there's an auction coming up in 2 days. Well, can you just do a quick title search? I mean, we can, but that's not going to be a comprehensive search. There could be something missed. We don't have the access to the resources that the title examiners for the title insurance industry have. They go back to the root of title. I mean, we can go back as far as anybody off the street, which is like early 90s. There could be something more, something beyond that. And we're not title examiners. That's not what we're trained or doing day in and day out. So my advice there is like, if you have an auction coming up in a couple of days and you absolutely want to proceed, you can do the best you can. You try to get an ownership and encumbrance report, which at least tells you the status of ownership and if there's any liens on the property. Those typically you can get within a couple of days. That always makes me nervous because it's still not a full comprehensive title examination.
Yeah.
Um,
We
but
usually have the calendar. We're going to touch on that later about how we follow the pre-foreclosure and then obviously going into foreclosure, those calendar dates for the auction, which we
right.
have access to that information. And a lot of times, we might even be representing really the asset manager or the bank. So
Mhm.
we're gonna know those dates. Now, depending on who we're representing, right? If we're representing the buyer as a single agent, as a fiduciary, obviously we're going to do all that due diligence. And yes, we're not going to recommend 2 days prior to that they're going to get all that information. I don't care how great the law firm is. I mean, you need the time to really understand what's going on. So I think we're going to really talk about due diligence a lot throughout the seminar.
Okay. Yep. And it's always different. I mean, whether you're buying the resale investments. I mean, that we have the FAR contracts, which are fantastic. Those are updated regularly by the committee, FAR committee, which is a group of realtors and attorneys. Anytime the law changes and it impacts the way that the contract's drafted, they get together. Some of the local folks in town are on that committee.
Yeah.
Some local attorneys, some local brokers are on that committee. Very smart people. Good contracts, very neutral, cover just about everything. But when you're buying off the hub zoos, when you're buying REO properties, they're going to have different versions of a contract, whether it's entirely different or like in the REO situation, a lot of times they use those FAR contracts, but they have a 30-page addendum that they attach to it, which changes very extensively some of those important terms that investors may not realize. It changing the obligation that the seller has to provide marketable title to insurable title. There's a very big distinction between those two terms. Changing the obligation of the seller to change from a full warranty deed to a special warranty deed, or even
Mm-hmm.
a quitclaim deed. There's very big distinctions between that. Buyers often think that they're just, canned addenda and it's no big deal. And if they trust that, Bank of America is not going to,
Right.
screw them or whatever. But, having those documents reviewed by the attorney in advance to know exactly what you're signing is crucial in those situations because they do change very, very vastly the terms in that standard contract that we're all comfortable with and which is fair. And so knowing what you're signing off on is important. Knowing what your due diligence timeframes are. Are they being very limited by those addenda or customized contracts? Is there a financing contingency? If there is a due diligence period, what does it cover? I mean, is it broad in favor of the buyer to get out based on inspections, or is it very limited in scope? Because buyers' deposits could be at risk from day one if those aren't understood.
Yeah,
And
and sometimes when they don't close, there's a per diem charge, and sometimes buyers miss that. And
Mhm.
I can see it right in there just from experience of working on bank-owned, foreclosure transactions back in the day. I certainly don't think we'll see as many as we did then, but I think we're going to see some coming up with forbearance. There were 4.3 million people that did not pay their mortgage in May of 2020.
we're already seeing that on sales where, obviously if a seller of property has a mortgage or any lien, we have to get a payoff.
Yeah.
Make sure we pay off the mortgage at closing. We're seeing that sellers are already in those forbearance deals, and it's actually really slowing down the process of getting a payoff.
Yeah, getting the closing done. Yeah.
Correct. Yeah. Normally, if it's a standard situation, we can get a payoff sometimes within 2 hours. We
Yeah.
can 24 hours, whatever. Some of these forbeared loans are going to different departments or being handled by outside, law firms or whatever, and they're taking, 2 or 3 weeks sometimes to get payoffs, which is something that, like I said, in many cases, less than 24 hours. So
It's now a question I have to ask sellers, when I'm talking about listing, have you missed a mortgage payment? Well, no, I don't need to make it because I did the whatever, sometimes they don't even know it's a forbearance,
Right.
but they said they were in a situation with the bank, and it's like, well, no, you still didn't make the payment, and of course you want to say it in the most polite way, but you have to almost warn them that we've got to have enough closing time, and there might be some hoops or some hurdles that we have to get through and preparation for closing.
And many of those may end up turning into foreclosures or
Hmm.
short sales, which pose great investment opportunities. But
Hmm.
again, you have to be even more careful about those. When people stop paying their mortgage, they stop paying everything. So
Everything.
they don't pay the utilities, they don't pay the HOA dues, they don't pay the lawn maintenance guys. So now you've got a code enforcement case for overrun law.
Hmm.
You've got utility liens. You've got HOA lien that's been farmed off to the HOA attorney to file foreclosure of that. You name it, it goes on and on. So once that can of worms is opened, it's like everybody starts to have their hand out on that property. And the more time that goes by, the more difficult it is to get all that dealt with. And it's really just, basically asking everybody who has an interest in that property, what are you owed so that we can pay you at closing and get all of these liens off there.
Yep.
So great investment opportunities in a situation like what we're going through, but it's peeling back the onion layers and making sure that everything is taken care of as of closing, so that the buyer isn't dealing with a huge HOA debt after closing.
Yeah, I've definitely seen that in the past. A lot of HOAs had not been paid, and
yeah,
without having sometimes an attorney or a great closing person on the other end, I mean, some of those things, especially when they're doing a lot of closings, fall through the cracks. I mean,
absolutely.
I've had many experiences where there was an extension on the closing due to not knowing, or the seller didn't tell someone, and we were representing the buyer, that they stopped paying the HOA. I mean,
Oh,
I'm like you. I'm going to assume if they stop paying their mortgage, everything else stopped being paid. And maybe that's not the case, but at least I'm assuming that's the case.
and it does happen more often than not. And the other thing that people will raise all the time is, well, doesn't title insurance cover that? Well, it does, but it depends on the closing agent. Now, if the closing agent is given a title commitment, which has 6 liens that need to be paid off at closing, that is the title insurance underwriter saying, you as our title agent may issue a clear title insurance policy assuming that you meet all of these requirements at closing. And in my example, that means paying off all 6 of those liens. If the closing agent misses one of those liens and doesn't get an accurate payoff or doesn't pay it off, that title insurance underwriter is going to say it is not a covered claim because our agent didn't meet one of those requirements. So then the client only has the recourse of going against the title company or the closing agent, and basically filing a claim on their E&O policy. But the title insurance is not going to cover that because the closing agent's going to be on their own for basically marking off that they met the requirement without actually meeting that requirement.
Right.
So that's something that when people say, well, there's title insurance, yes and no, there's more to the analysis. So
I feel
again,
like that's just the easy answer. Well, there's title insurance. Well, that's great. And
it doesn't cover everything anyway. I mean, there's a
right.
lot of things that just generally aren't covered by title insurance that people think is covered by title insurance. But yeah, and it just goes back to your comment before. I mean, so you have to really be able to trust that closing agent that they're going to meet all those requirements, and looking at the title commitment itself and seeing those requirements, and you could even go as far as to ask for a marked up commitment, which is the closing agent actually marking up the commitment and basically signing it saying we have met all these requirements. Like in commercial deals, that we do that all the time. Large
Yeah.
large commercial deals that another law firm may be closing. One of the things that I always require before it closes, um, whether I'm representing the lender or the buyer, or whatever, is a marked up title commitment. I want to see that closing firm has done everything that they're supposed to do.
Yeah. Well, gosh, Ryan, that's a lot of great information. I could probably interview you for an entire 8-hour period or even a weekend seminar, but I know that you are extremely busy, and I know you're working on one of our files right now, along with many others. And So how can anyone contact you if they're looking to just say, hey, how should I be set up, or find out more about your services?
Yeah, and we do work with investors. We do business formations and mergers and what we call annual maintenance here, where we'll file annual reports and annual maintenance, blah, blah, blah. They can call me, and of course, we do all kinds of residential and commercial closing. They can call me or email me. I'm happy to, should I just rattle off my information?
Or if you want, we can just put it in the chat so you can hang out on the Zoom, or if you've got to get back to work, we certainly appreciate that too. But
No, it looks like it's right there. There.
Megan's pretty proficient when it comes to monitoring the chat box and making sure all the information's on there. And this will be recorded. I know we have some guests on now, but it's just now 4:23. We probably have a lot of people still working, but they can come back and watch it on our watch party on Facebook. We'll put it on LinkedIn, and we'll go ahead and make sure we have all the links and contact information for any of our guest speakers on there. And then of course our team members, in case you have any questions about investing in your financial future via real estate. That's what we do. So thank you, Ryan. And
I'm willing, to hang out. I'm in my office, so if
hey, hang out as long as you want. And if you need to put us on mute, or you need to mute yourself, if you'd have to take a call, we get it. We're in the business.
Well, if you want to follow up with any questions, I'll be right here.
Okay. If anything sounds like I need an attorney, you can jump in whenever.
All right, that sounds good.
I can only share my broker experience. All right. So obviously we're going to talk about taking hold of your financial future, investing in real estate. I think most of you know who I am. If not, I've been in the real estate business for 16 years. I've been a broker for 14. As soon as you get into real estate, you have to go to school. You can go to school about a year and a half in, but you have to have 2 years experience. So that's why I've only been a broker for 14. Probably would have done it day one if I could have. I love being in charge of my money. So that's why I decided to do that. I also own a Keller Williams franchise. Keller Williams is the largest real estate company in the nation. We're also growing exponentially in the world. We are the largest for agent count, units sold, and volume. So I love working with this company. They have a great culture, and we have an extensive referral network of agents should you be looking to invest in other areas. We usually have 3 experts at minimum that we can refer you to if you're looking to build out your portfolio. And that might be in a vacation property area, or it could just be someplace near your family in another area of the country. So don't just think of Florida. We just opened a few more offices in Asia. So we are global, we are national, and we have all the experts at our fingertips. I also have some designations. I'm accredited buyer representative. So that's specifically if you'd like buyer representation as a single agent, as a fiduciary. We do sell some luxury. So I'm a certified luxury home marketing specialist. And I'm also a certified international property specialist. So we do handle a lot of international referrals, believe it or not. And I'm also a certified residential specialist. Basically what that means is the number of years you've been in business, you have to average that at minimum for sales volume. So that means I have to do more than 16 million a year to stay in that club or network, if you will, and also do a lot of schooling. I'm also a resort and second home property specialist. What that means, somebody's talking. So can we mute all the attendees, Jessica? Sorry about that. A resort and second home property specialist. Basically, I have a referral group of agents. We refer, like I said earlier, back and forth for resort and second home areas. We are in that kind of destination location where we have a lot of people buying as a second home. And then trans referral certification, that just means that I am able to refer to another agent overseas, even if there's not a board of realtors. All right. So for anyone on the call here, if you just want to kind of comment in the chat box or raise your hand, and we will unmute you if you're not muted, or if you are muted. Do you currently own an investment property? That would be an investment property outside of your residential property. Or number 2, do you own more than 1, more than 5? Do we have any savvy investors on the call, Megan?
So far, I haven't had anyone answer yet or raise their hands.
Okay, so we're gonna gauge
the questions in the chat box too.
Okay, yeah. So we're trying to gauge the audience, just so you know, and then we'll obviously take some questions on Facebook later, and if we can answer any just basic questions. We're going to kind of base this on you have no experience or you're just looking to start investing. Otherwise, let us know if you jump on and you have extensive knowledge. We can jump into a lot of really intense worksheets that we love to use when we're analyzing properties, or we can email them to you. We regularly work with investor clients, so there might be some agents on here that are looking to get into that market or part of the industry. We have several clients that are repeat clients that own a lot of real estate. I mean, we're talking hundreds of properties, sometimes more than that at one given time. And then also, do you want to invest to grow your personal wealth? I think most of us on this call are probably looking to do something like that from looking at who's attending that I can see on the screen. So for those of you here, what would you like to learn today about investing specifically? I know, Megan, you've got a lot you want to learn.
Yes, I am on here not only because I'm your business partner and on your team, but also we have conversations like these all the time. And I am so excited to start building my own real estate portfolio, or as I like to say start playing Monopoly.
I love that game. It's my favorite game.
Yes, so definitely I love looking at the worksheets.
Okay.
Just showing how you can leverage the equity that you're building in properties to collect additional properties and how you can make those cash flow.
Okay, awesome. So I have a few new worksheets for you. So I'll bring up some of those samples since the last time we have spoken, and I'll share those with you. Anyone on the call that would like those.
Thank you.
So we have a couple of options when we're investing in real estate. We can buy for cash, like Ryan had mentioned earlier. We can find and refer. We can flip the property. Or number two, this is kind of where I live. I like this number two, and I think Megan knows this a lot and most people on my team. Buy for cash flow and equity buildup. So I'm more of a buy and hold type of investor, and that's actually the majority of my clients. I do have some that like to flip. I will say that there are very few people I have met in the real estate industry that really understand how to analyze the property on how to buy and flip. A lot of times they speculate, and I find that can be a little risky. So, if they go and buy it without us and then they're trying to flip it later, it always leaves us in kind of a position. So we always advise to build your team, your attorney, your real estate broker, whether it's us or someone else, your CPA, your inspector, and we'll get into building that team later. But it's always wise to really have advisors around you. Also, lease option. Megan knows the first commercial building I ever purchased was a lease option, and it was an off-market deal. So that was really nice to be able to purchase that. And that's actually an office for us with Keller Williams now. So these are the two books that this PowerPoint is built on as far as knowledge and key talking points. Millionaire Real Estate Investors, written by Gary Keller. He's the founder of Keller Williams. And also Jay Papasan is on here, and Dave Jenks. They also were involved in writing this book. It's a New York Times bestseller. Highly recommend it. I have it on audio. I listen to it when I'm running or now on my Peloton since we're dealing with COVID right now. So it's a great audio book just to listen to, take notes. You're definitely going to need a notepad. There's also worksheets that come with that I'll share with you later. Hold is about how to find, buy, and rent houses for wealth. That is probably my favorite book right now. My third favorite book would be Tax-Free Wealth, which we'll get into later. Full disclosure, I'm not a CPA, so I will be referencing the book. Okay, so what are we going to do? We're going to establish our why. Why are you looking to build wealth through investing in real estate? Budget like a millionaire. Learn how to track your net worth. Understand the language of real estate. Avoid the pitfalls of investing. Number 5 is going to be really important. Build a team. I cannot emphasize this enough. Do not invest alone. Make sure you have either mentors around you or you have tax advisors, people that you really trust that have worked with experienced investors in the past. Confirm your investment criteria. I really say get that criteria down and do not deviate from it. I find that when investors try to do, flipping and they try to do buy and hold, a lot of them are kind of going outside of their wheelhouse and they're not sticking to their one thing, which is that criteria they've selected, and just do not deviate. And if you start prospecting for that specific criteria and the location you want to invest in, I find that they're going to make a lot more money and they're going to do it a lot faster. So you want to practice, you're going to analyze deals. Megan's actually a student right now doing that. And I'm sure she's played around with some of the worksheets and Excel spreadsheets that are created for her. I used to create them and use Excel to create formulas back in the day because I didn't have anyone to give them to me. So imagine doing that, Megan, creating all your lovely formulas in an Excel college class about 20 something years ago.
That's awesome.
Now I'm aging
Although
myself.
it is so much easier to just have it handed to me and I just plug and play.
Yeah. Well, if you ever want to learn how to create the formulas and the cells, I can let you know. Little fun midnight homework. Practice and analyze your deals with those worksheets. Lead generate. I love lead generating. Everyone on my team knows this for investment properties. I did a lot of that today. I used some software program that's provided free of charge with Keller Williams, and I'm looking for several investments for clients. So I think there'll be some more opportunities with commercials specifically coming up for some of my clients. So I'm so excited about that. It's like treasure hunting and just digging for gold. Number 10, finance and buy, invest your property. We have Tony Fitzgerald that's going to speak later, and he is a finance and buy guru. Okay. So he's with AmeriFirst. They have a lot of great programs. He'll go into detail and answer all your questions. I love leverage. So I am not that cash buy investor. Not my thing. If that's you, that's great. I'm just going to show you why later I think that there's a lot of great tax benefits based on the information I've received in wonderful books. Like one, for instance, Tax-Free Wealth. Manage like a pro. I now own 2 property management companies. I can officially announce that I own 2. We were in the works working on that. And I am very much looking for talent. So if anyone knows any other property managers, I would love to be able to attract talent and build more inventory by attracting managers to help us manage our properties. And we'll get into that later. Okay, so why would we build wealth? Obviously, there are people that want to retire early. You guys know I have several businesses, but the reality is I could stop working today and just rely on my investment income, which I'll never do. I think you guys know I'm not one to sit around. COVID's kind of driving me crazy. But if you're thinking about your future and maybe you do want to retire one day, and maybe that's 5 years from now, 10 years from now, or 20 years from now, we're going to talk about where you're at in that process. So we have retirement and we have you. So do you know what you need to retire? And are you on track to meet those goals? So for anyone on the call right now, do you know the answers to those very interesting questions?
Checking the chat. We don't have any responses yet.
Everyone's too shy to say where they're at.
Yes.
All right. Well, we're going to get into this.
Exactly.
All right. So retirement reality check. Obviously, this is your little pathway here. Now we have several different people, different ages here. So we have someone here at let's see, 100,000 a year as their goal for annual retirement goals. If they started at 20, at $100 per month that they were putting away, maybe they could retire 64 years at 64 years of age to achieve their goal, or spend 64 years saving that to retire at 84. That doesn't sound like very much fun to me. So we're going to talk about how we can fast track that. Then we have 200,000 a year. That sounds a little bit better to me. Starting saving $500 a month at age 30, maybe that's 52 years to achieve that goal, and they can retire at 82. I don't really want to retire at 82. So maybe you start saving $2,000 a month at age 40, you have 25 years, and you can retire at 65 or even earlier if you buy some more real estate. But this is just kind of saving for that goal. So if you were to follow 100 people from the start of their career for 40 years, what would you find? 1 would be wealthy, 4 would actually be financially secure, 5 would be working, unfortunately 36 would be dead, and 54 would be broke.
Those are some.
That's why we're having. Huh?
I said those are some sobering numbers.
Yeah, but this is really why we call it a retirement reality check. So obviously, you're all on here. You want to be that one individual out of following those 100 in 40 years that will be wealthy, or even sooner. So here's a case study. Jimmy and Linda McKissick are part of the whole book. They're actually one of the case studies in that book. There's several investors in there. So in 1991, they had $600,000 in debt, okay? They started their first investment. They had no money of their own. They partnered with their builder. They end up getting into real estate. They located the property. He put up all the money, believe it or not. He did all the repairs, and they flipped it for a $15,000 profit. Now, remember, this is 1991, so it'd be a little bit more money now. Invested profit in another deal, and then fast forward to 2003, Now, again, this is 17 years ago. Imagine their net worth now. They had a net worth of $10 million when they started in 1991 with $600,000 in debt. So they were negative, and then all of a sudden, boom, they ended up with $10 million in net worth, which probably a lot more now. So in 2003, they became millionaire real estate investors. At that time, they owned 48 single family homes, my favorite investment, one fourplex, one duplex, one small complex, one commercial space, and one residential development. Pretty impressive. So if you're on the call right now and you have debt, here's what you can do in a matter of years, in a very short time. So how does this compare? Some of you on the call might say, well, I have stocks, or I have a 401k, or I've invested in mutual funds or money market. What do you see the biggest differences in these investments when you're looking at this? Just what catches your eye when you're looking at this?
Well, two things: the cost to invest and the potential loss for investment property for that cost.
Good eye, Megan. Most people don't catch it that fast. So if you didn't see it right away, over here, this is our residential or maybe a commercial investment, but based on the $100,000 investment, I would think it's residential. Maybe there's $100,000 commercial out there somewhere. If there is, please call me. I'd love to be able to purchase that, even if it's outside of my area, because it doesn't exist here. You only have to put down $20,000, okay? Then down here, you have a potential loss of 40% versus this 100% over here. This really catches my eye the most, though, Megan. If you look at the adjusted rate of return, or rate of investment, or return on your investment, excuse me, stocks is 4 to 7%, mutual funds 6 to 9, money market 2%. With real estate is 25%. And I know that sounds high, but we're going to walk you through that, okay? And the other thing that catches my eye is carrying cost. You have a tenant that's going to pay down your debt, also known as your mortgage.
Amazing.
So I actually really love debt, and people think I'm crazy when I say that. I'm not saying I have a negative net worth. What I'm saying is I love leverage and I love debt because there's some benefits tax-wise that help me. I own several businesses, so owning real estate helps me tax-wise. And someone else gets to pay down that debt, and I get appreciation. Now, this is taking a 5% appreciation just to be really conservative, and that might be over a long period of time if you're going to hold. But that's kind of what we use as an average. They were also using a 10% vacancy rate. In our area, we're not seeing that. It might be more like 4 or 5, maybe even less than that, because a lot of people are coming here from other areas, especially with COVID. Okay, so this is an example of a property over a 16-year period. Let's just say in 1988, you purchased it. Okay, this could be someone in the past that's done this. $72,000. You have a down payment of $20,000, which equals $14,000. Your mortgage loan amount of 80% of that original purchase price is $57,600. So you can see the difference. Maybe you're starting at an older age. I started investing much later than I probably wish I should have. I know Bria's on the call. She's already starting a lot younger. Then she's in her early 20s, and she just bought her first home. So now we're going to look at other investments for her. But 30-year mortgage versus 15. If you are starting later in life, 15 might be something to look at. So you can see your total net cash flow. There's a difference there, right? You have a 34,000 roughly versus 18 with the 15-year. Then you have total equity buildup. You can see you have a little bit more equity over here. And then total return, you can see the difference there. And then annual rate of return. So those are pretty good numbers. We're going to break these down even more. I just want to share with you kind of a basic example of a property over a 16-year period. Okay, so going back to your why, Megan, what is your why, or anyone else's why that's unmuted on here? Why would you want to build your net worth up?
So I've got multiple reasons, but a really big reason for me is so that I can give back in a big way. I think we have a unique opportunity in our business because I can do the treasure hunting myself. So that gives me an edge. But if I can build wealth, then I can give back and make big impacts in my community.
I love that. You're going to get me all teary-eyed, so I'm going to the next slide. Let's get back to numbers. I do better with numbers. So why do you want to pursue financial wealth? Well, Megan just answered that. Maybe you have a different why. Maybe you have a family. Maybe you have loved ones that you want to be in the position to help take care of. And then I'll keep asking you why. Like, why would you want to take care of them? And keep getting deeper to your why. That's going to basically equal your motivation. Megan's motivation is so she can give back to her community and do big things. And that's probably with a charitable cause. If I know what she's talking about, there's a specific charitable cause that's really near and dear to her heart. So that's going to give her the ability at any given time to be able to do that, which also is a great tax benefit when you're being charitable. So what is your financial freedom number? Now, I've asked some of my team members in the past what this number is. I don't know if anyone wants to share that or anyone else on the call. Anybody know what their financial freedom is? I think Jessica had a pretty good number. Wasn't hers like 25 million or something like that?
Yeah, it was great.
I'm here. Sorry, I have you muted so you don't hear my zoo in the background.
That's okay. We need them listening in so that they can build their financial wealth.
Yeah, my goal, I believe, is 20 million.
All right. I thought we upped it to 25, but that's okay. We'll stick with your 20 for ease of numbers. Okay, so here's an example. Again, going back to Jimmy and Linda McKissick, and the only reason why we keep referencing them is because they started out with a lot of debt, and sometimes I think people get really discouraged and think like, I can never be an investor. I can never build my net worth. You're in real estate, Brandy, like you know the market. I got started really late, honestly. I wish I was like a Bria and somebody was teaching me this at that age. I was in college learning science and medical terminology, and I knew numbers, but I didn't know anything about investing with those numbers. So I like using Jimmy and Linda because I think people have a fear, or they think like, why do I deserve it? Or, you know, I have a lot of debt. This seems impossible, overwhelming. You might even have clients that have a fear. So when you're having these conversations, you might want to share examples of other people that have gone from having that debt. We are going to see some short sales and foreclosures. I feel like we have an opportunity to help those people get into rentals, build their credit back up, and have some really real conversations with how to build their net worth moving forward so that they have a real true advisor rather than someone that just sold them a home that they may or may not have been able to afford in the first place. So I feel we have an obligation to do that and help people, whether they have money or they don't have money. We should be able to help all people in building their net worth, especially through real estate. And that takes a long-term commitment when you're putting them in a rental for a few years until they get their credit back. But I think that's our obligation. So our goal here with Jimmy and Linda McKissick was to quit working in 20 years. So it was $20,000 per month of passive income. And then their achievement strategy, right? You have a goal and then you have a strategy to reach that goal. Buy 20 single family rentals. Sounds like a lot, right? Well, if you can break it down to each generating $1,000 cash flow per month, you can complete purchases in 5 years. It doesn't seem as overwhelming. Now, again, they were going to finance on a 15-year note because they got started a little bit later in life. So that might be different. That might be a 30-year for you. And then they wanted to put 20% down. So how do we get there, right? How are you going to get that $20,000? That's probably a big question mark for a lot of people saying, okay, I'm starting to make money in my job, or maybe I'm in debt. How do I budget like a millionaire, as if I really were a millionaire? So as an example, if you were to receive $5,000, let's say you closed on a property or you received a paycheck, whether that's your salary or maybe it's a bonus or who knows where you got the money from, what would you do with it? Are you going to spend it, save it, invest it, or donate it? Megan's inclination is going to donate it, but what we're going to do is have her invest it so she can donate more later. All right. So understanding the path of money, I really wish someone would have shown me this really simple chart when I was like in high school or just becoming a young adult. So do you work for your money or does your money work for you? Most of society, they're actually going to be in what we call that cash flow left side of the quadrant, right? They are an employee or they're self-employed. So we want to shift them over to a business owner or an investor. And if you haven't read Robert Kiyosaki's Cash Flow Quadrant, that's another great book. I highly recommend reading Rich Dad, Poor Dad first, because I think that's going to give you an understanding of what net worth looks like and how to build it and how not to spend too much of your money on what I call discretionary items or a discretionary lifestyle or a luxurious lifestyle. I know we all like nice things, but it really makes more sense to invest so that you can live whatever life you'd like. And then you'll be able to have other things and be able to help others. So two kinds of capital. We have human capital. You work for the money, right? That's most of society. Then you have what's called capital assets. Your money works for you. I really like the right side. I'm really digging this right side. Then you have cash flow, right? That comes from those. So you have 4 choices for cash flow. You can spend it, you can save it, you can donate it, or you can invest it, just like we said. 2 basic investment choices as well, lending or owning. Then we have what's called passive income and active income. Passive income is lend. You're going to lend the money into money market, CDs, bonds, treasury bills. You don't have a lot of control over here, right? They control your money. You can own stocks, real estate investment trusts, mutual funds. Again, they control it. Active income over here to the right, owner financing. You can be a private lender. You can, which is lending. You can own businesses and real estate. I really like the right side. I'm not opposed to getting into seller financing or lending. I think there will be a market for that. Haven't seen much of it lately because we have people like Tony that know how low the interest rates are, and he's going to share how beneficial it is right now to actually go and get a conventional mortgage. We might see some opportunities for other people wanting to quickly close on a property and kind of look like it's a cash deal. They might want to do some owner financing or private lending options. But I really love owning businesses, and I really love real estate. So there you go. That's how you get financial returns. So build habits to develop a financially wealthy money matrix. Again, another great diagram I wish someone would have shown me at an early age is basically the way income and cash flow works, and the way capital works and consumption out. You can see the top one is a representation of the financially poor money matrix in action and a financially wealthy money matrix in action. So if nothing else, taking a screenshot of that, putting that on your computer, your vision board, it's going to really help you. So how do you budget like a millionaire? You're going to examine your budget. How does your required spending compare to your discretionary spending? Okay, well, if your required spending looks like this compared to your discretionary, or sometimes you're spending more of your fund money and you're saving this and investing this, maybe you need to reevaluate. So how can you do that? Megan, we've talked a lot about printing out bank statements and looking at your last 4 months or going back to January. A great way to look at this is highlighting in different colors what made sense to spend, what was really a true expense that needed to occur, maybe your water, your electricity, maybe it was food, right? Now that's also debatable. It could be a lot of restaurant spending. So we'll get into that another seminar, but really looking at your necessary expenses versus what could you live without? Can you live without going to Starbucks 1 or 2 more days a week? Can you make some coffee at home in your French press that tastes amazing versus that? Maybe you learn how to cook really well at home, so you're spending less money and not running for breakfast, lunch, and dinner. I watch a lot of people do that. Well, that's great if you're having a business meeting for tax purposes, but if it's just you, you can make it at home and save a lot of money, and that can save you. All right, so start budgeting like a millionaire. Figure out where your net spendable income goes each month, printing out those bank statements. It's always much more fun to have a buddy because it can be pretty boring, or maybe hiring a bookkeeper, right? A lot of times if you don't have someone kind of over your shoulder, you're not really going to circle what's discretionary or highlight it. Separate your spending into required and discretionary categories. And then number 3, once you get to that point, set up separate accounts to manage required versus discretionary spending. Another great book, I know I'm probably overwhelming you with books, but this is a really good book. It's called Profit First. So that'll help you learn how to set up your accounts where you can't touch certain ones. All right. So when you start saving, you're going to explore your ways to reduce your expenses, question discretionary spending, consider ways to increase your income. So now we're moving on to increasing your income, not just saving. Automatically deduct 15% from your income to save for investing. So that's non-negotiable. I think Ryan's having a phone call. Can you mute Ryan, Jess?
Are you doing it with John? Oh, okay. Yeah.
Maybe I can. Okay. If we need him, we'll call him in. Set up a separate investment savings account. So that can be really simple, just taking that 15% off of each time you make a paycheck, or each time you have a bonus, or if you're in real estate, it's a commission, and setting that aside. We'll get into a little bit of tax stuff later for us real estate agents. So learn how to track your net worth. Now, Megan, I know you love this part. So here's an idea of the impact of real estate ownership on net worth. From 1998 to 2016, there was a study, and you can look at this. The source is Federal Reserve government publication files. So I'm not making this up. I'm not pulling this out of thin air. A homeowner's net worth is significantly different than a renter's net worth. So you can see from 1998 to 2016, there's a huge difference. So that right there should open your eyes to, if not buying your first home, looking at an investment property too. Okay, so understanding appreciating assets. I really don't want to own anything that's not an appreciating asset. So on here, you can see 401k, vacation home savings account, and personal residence are all appreciating assets. Now, not to say in our business, our car might not be something we can depreciate, or if you have a lease, maybe you can write off. You need to talk with your accountant or CPA on that. But in our situation, we use our car a lot for business. I think most people do. Okay, so what is your net worth? I mean, if somebody asked you, calculate your net worth, what is that? It's really simple, okay? It's not complex math. It is what do you own and what do you owe? That equals your net worth. So you own typically a home, a car, maybe you have a 401k. That comes to $226,000, as this example shows, probably a lot more for savvy investors. And then you might owe on your mortgage. Then you might owe a little bit on your car. You might owe on a student loan. So if you take this, what you own minus what you owe, you come up with $3,000. So there's your net worth. Some of you might be negative. Somebody might be really, really positive. Everyone's going to be at a different level, but just start tracking it.
And we can't define where we're going until we know where we are. So the very first thing is to identify, where are you?
I love that. Can you put that in the chat box?
Yes.
I love that. Okay, so now getting back to real estate, right? Figure out where we are so we can go and look back at real estate and how to purchase it. Understanding the language of real estate. It can seem confusing if you're not in the real estate industry, but we're going to break it down for you. So profit or loss. Here's a real simple problem. You have, or not a problem, just an example. Purchase price, $100,000, down payment of $20,000, loan period of 20 years, monthly cash flow 0, sale price $100,000. Real estate is the most able investment. So what I really like about this, a couple things, but the top 3 I'll share here in a minute. They're accessible, appreciable, leverageable, rentable, improvable, deductible, one of my favorites, stable, and livable. My 3 favorites on here, I think everyone knows I love leverage. So the fact that it's leverageable, you can borrow money, right, to purchase it. They appreciate every single year. The market might go like this, up and down, but on average, typically it's going to appreciate over a long period of time. And there are so many deductions, which we'll get into later. And those improvements, right? You can always improve it. Okay, so here's a typical real estate cycle. Typically there's a boom for 10 to 15 years, and then you have a 2 to 5 year bust. There's a floor, then you have another boom, then you have another bust, pricing floor, peak prices, then you have another boom. So again, there's going to be ups and downs with real estate, but if you were buying and holding like I like to do and having someone else pay down your mortgage while your equity builds up, to me, it's a win-win. Plus, if you own businesses or you're looking at getting into owning a business to build your net worth, you have some tax benefits too by owning real estate. Okay, so the power of leverage, equity buildup, understanding the language of real estate. ARV stands for after repair value. So you're going to hear some of these acronyms or some of these terms, and these are the true definitions. And these are all in these books. So if you'd like to reference back to these terms and definitions, those books, we will certainly point you in the right direction of where to find them. They're all on Amazon or kellerinc.com. 1% rule. So if you divide your monthly rental income by the property value, does it equal 1%? This cash flow metric is used to quickly analyze an investment prospect. Now that's a really basic rule. We can get into some really, there's like 36 different metrics and understanding in terms with investment properties. We're going to stick to the basics today, and then maybe we can do a 102 seminar later if you start investing. It can get really complex, and we would need a CPA on the call to kind of help guide you. Cash flow, earnings after the cost to own a property. Net operating income. Net operating income, the profit you are left with after operating expenses are subtracted from income. Now, a lot of people think they know what operating income is, but we're going to show you examples of what those true operating income expenses are. Or excuse me, operating expenses, not income. So net operating income is the profit left over after paying those operating expenses. So return on investment, the amount of money you make in 1 year divided by the amount of money you initially invested, okay? Then you have your capitalization rate, often shortened to cap rate. It's return on investment for your property if you had paid cash. House hacking. We don't hear this as much, but renting out a part of your property to generate income while leaving the rest. We don't really see a lot of that in our area, but that term had been around previously. Value add. We hear this a lot, specifically in commercial with multifamily. The ability to increase a property's value through prudent efforts. We recently closed on a multifamily, great price, $3 million downtown area, opportunity zone, and they had a lot of value add. They've been able to increase the rents and also fix up some of these small units, and it gave great affordable housing to the tenants. Emerging market, the area, location, or part of town where growth is occurring and expected to continue. Consider the hotspot. Okay, so confirming your investment criteria, how to calculate your return on your investment. Again, yearly profit divided by initial amount invested. Then over here, you have a calculation, very simple example of $500 divided by 10,000 would be your percentage return on investment. Okay, then you have an ROA calculation. You have a purchase price of 100,000, down payment of 20,000. You might have a rehab cost of 10,000. They're all worksheets that will help you with this, so you don't have to memorize any of it. It makes it a lot easier. I'll share with you. Interest rate of 5%. That might be less, might be more. Rental income, 14,400. Again, might be less, might be more, depending on the area. Mortgage of 5153.49. Property taxes of 2,000. Insurance of 500. If you have a management company, it would be 1,400 roughly. Maintenance reserve of 720. A lot of people forget to have a reserve. Vacancy rate of 720. And you have an annual cash flow of around 3907. So that's how you get to that. Okay, so challenges. Investment properties are harder to find right now. I think that's going to change with some of those forbearance, probably August and September when they're up. We're going to see some investment opportunities. Core on our team's been contacted by some asset managers to make sure he's up to date with all his applications, because he used to do a lot of REOs. So I think we'll be seeing some of those opportunities. If they're calling the experts in the field to get prepared for it, that means we're going to see them. Interest rates are increasing. Actually, right now they're pretty low. So some of these slides are from before. Fewer available distressed properties. Again, we might see more here soon. Prices are increasing. Not really much right now, honestly. We're not seeing it go crazy. Fewer investors in the market are the advantages. That is certainly true. Interest rates are low compared to the past. That is very true. Rents are rapidly increasing. We are seeing that. And then there's a high demand for rentals. I'm definitely seeing that with the property management companies. And I'm going to show you some statistics later of why we're seeing a lot of people coming here to rent. Okay, so power of leverage. We've kind of already talked about most of this. We'll kind of whiz through here. Obviously, in the beginning, you have a little bit of equity, you have an investment, and you have some debt. That debt's going to shrink down as you build more equity, as someone else pays down your mortgage. And then eventually, you have a great investment and you have a ton of equity, and that's what we like. And now you're growing your net worth. So what does this look like when you have a rent appreciation plus debt payoff? Cash flow growth is what we call this in real estate. So you can see cash flow increases, vacancy expenses are still there, but your debt service is gone. All right, so there are unique propositions of investing in real estate. We've already talked about stocks, mutual funds, money markets. Real property is an able investment. Its value never goes to zero. That's something you definitely want to remember when you're speaking with an investor client, or if you're an investor yourself. Purchasing real estate property can be leveraged. I love leverage. I think it's the best thing about real estate. Again, it's accessible. Anyone can buy it. Appreciable, increases in value over time. Rentable, you have cash flow, cash flow, cash flow. Money is making while you're making money while I call it mailbox money. Some people don't receive it. I know Jessica knows on the call. I have some renters that they Zelle it or they Venmo it. That's even better, because then you get a Venmo statement. You can send it on over to your accountant. They can see everything you've spent. And a lot of times now I have my vendors Venmoing me, like my lawn guy, so I can pay those services. And then it's one statement, and I can write next to it as a memo, this was for this property. So my accountant, boom, he has everything ready to go. It's improvable. You have sweat equity, deductible, depreciable, and deferrable. Deferrable will be something like a 1031 exchange, which you can get into later. I have a blog I can send you written by a CPA. Stable, slow to rise and slow to fall most of the time. Livable, you always have shelter. That's one great thing about rent. You can always move into your investment. All right, so you've seen this before. So this actually shows you at the bottom how we came up with that adjusted rate of return, that 25% down here. 25% equals 5% of 100,000 recalculated for the actual $20,000 investment. Okay, so this shows you how that's broken down. Using other people's money is leverage. Banks, mortgage companies, and owner financiers to make money. Leverage multiplies your profit, okay? Appreciation of rent are based on the total value of property. Return on investment is calculated by money invested, 20% or 20,000. So it shows you that calculation we just went over on the last slide. To make the money in a mutual fund yielding 10% with no cost, you would have to have $250,000 in cash. So what if you don't have $250,000, but you can come up with 20, or you can save the 20. There you go. You have your first real estate investment. So here's that other great book. This book was written by Tom Wheelwright. He's a CPA that actually represents Robert Kiyosaki and many other investors, but he's known for representing him. So he's a rich dad advisor, if you will. And so some of the write-offs are operating expenses, and this all comes from his book, management leasing, etc., mortgage interest, financing costs, maybe points up front, miscellaneous closing costs, depreciation, structural value of the property. You cannot depreciate land. We'll get into that later. Capital improvements, new roof, siding, things like that, personal property, and maintenance and expenses. Again, you cannot depreciate land. So these are some charts from his book. He actually gives you an entire PDF. I can share with you where to find this if you'd like. A lot of people say, okay, well, why do you want all these tax benefits? Shouldn't you be paying your taxes? Well, I disagree. I pay taxes, but I would like to pay minimal or none. And here's why. The government wants us to create more jobs. As business owners, I own several businesses. I create lots of jobs, and I can't wait to be able to own more business so I can create more jobs. We have over 100 agents in the market center. I have people on my team. I have a staging company, property management company. I can't wait to have more so we can employ more people. Also, the government wants you to provide affordable housing. Maybe they've got clued in that they're not great at it, or maybe they just feel like it's better if a real estate developer or real estate investor does it. So who creates more jobs and provides more affordable housing? Entrepreneurs, real estate investors, right? And you receive tax breaks to encourage job creation as an entrepreneur, and you receive tax breaks to encourage housing. So the law is written that way. So when people say you should be paying your unfair share or this, that, and the other, or your fair share, well, if I'm creating jobs and I'm creating affordable housing and I'm doing these things, I feel great about it. So here's an example of depreciation on a real estate investment. This is where it gets really cool. So let's say you buy an apartment building. This will be a small apartment building. I've yet to find one for 800,000, but this will be a small apartment building, right, Bria? I don't think you've ever seen a apartment building. You've worked for other commercial brokers before.
Never seen one. That'd be great fun.
Right? How many more clients would we be able to find if we could actually find an apartment building for 800,000?
Mm-hmm.
So minus the land, right? We cannot depreciate the land, equals the value of the building and context. And again, this is from Michael Wheelwright's chart. I did not create this, a CPA did this. The value of the building and the contents would then be 600,000. So minus contents of the building, that would be 100,000 equals value of building 500,000. Multiply value of the building by the depreciation rate in the US on residential property would be 18,000. So then you have the contents of 100,000. Multiply by 20%, okay? That equals contents depreciation deduction of 20,000. So you have building depreciation deduction of 18 plus your contents, again, no land involved, 20,000. So now you have a total depreciation deduction of 38,000. Okay, so how long can you depreciate this? Again, this is from Tom's book, and this is also straight from the IRS. Most residential rental properties depreciated at a rate of 3.6% each year for 27.5 years. Only the value of the building can be depreciated. You cannot depreciate the land because it will never be used up, right? The building can have disrepair and things can happen. Commercial buildings and improvements generally depreciate over 39 years. Depreciation means that you can deduct a portion of the building and improvement cost every year over the building's depreciation period.
So I have a question for you while we're on this slide.
Sure.
How often or how long do most of the savvy investors that you work with who are basically always holding property and renting it out,
Sure.
how long do they typically own those properties before they decide to sell or do a 1031 exchange, maybe buy a more valuable asset?
Usually until they see something that strikes their fancy because I put it on their plate.
Gotcha. Do most, or do you know if the investors you work with, do they know that they have 27.5 years to depreciate that property? And so somebody
well, 27.5 would be for residential. You have longer for commercial. So what I've seen personally is they'll hold it for 5 to 7 years, maybe 10.
Okay.
And then, but if they see something that's a good deal, now remember, investors are going to strike while the iron is hot.
Mm-hmm.
And if they can defer their taxes with a 1031 exchange, or if something comes up in an opportunity zone, they might want to buy that. Now, you do have to hold stuff in an opportunity zone, right? And that can be what we call tax-free after, I believe it's 10 years. So we'll get to that slide in a minute. But great question. You're well ahead of the slideshow here. All right, so tax consequences, cash flow from real estate, let's say it's 12,000 minus depreciation deduction of that 38,000 from the previous equals a loss of 26,000. So cash flow of 12,000 is entirely tax-free. Potential tax refund, amount of loss that can be used against their income, 26,000, now multiplied by their tax bracket. Now 40% might be an investor's tax bracket. Your tax bracket might be different. This is just an example. Equals a potential tax refund of $10,400.
Wow.
Isn't that cool?
That's amazing.
Okay, so I like moving people being friends, family, clients, all the above. From the left side of what we call the cash flow quadrant, which is really just a few deductions you get. Mortgage interest, property taxes, and charitable donations. All great things, right? We all want to be charitable. We all want to own a home. And unfortunately, we have those property taxes. We want to move to the right side, to a business owner and investor. Why is that? Because look at all these possible deductions that you can get. Business supplies, right? So when we need business supplies, I don't need you to call me and ask me for permission. Order away. We have a deduction here. Business equipment. Do we need a new printer? Yes, we do. We need one every year. Marketing expenses for business. Do we like marketing our business? Yes, we do. Home office. Yes, we do.
Especially this year.
Yeah, we're going to get a nice one this year. Right? That's a great benefit of buying another building, which we'll tell everyone about later because it's in the process. But home office, vehicle use for business, meals, right? I always say to Megan, we need to have more business lunches. We have so much fun and then we can go back to work. Travel. So you can travel if you need to get educated on your business, or maybe you're looking to invest and you want to go to that area, you can travel and deduct some of that. Mortgage interest, property taxes, and charitable donations. So do you see why the right side of the quadrant is so much better?
Yes.
Okay. So Ryan was touching on this a little bit earlier. Full disclosure, not a CPA or attorney. This is out of Tom Wheelwright's book and a PDF that he uses as a tool, using entities for asset protection. So I want you to just look at this. What do you think would be the best way to protect yourself? Depending on your investment, but.
A trust or an LLC.
Yeah, pretty evident, right? This chart is just so simple. So simple. And I think everyone tries to overcomplicate it. Like, how do I set up, do I need a general partnership, a limited partnership, corporation, limited liability, S Corp, trust? Here you go. Very simple.
Yeah.
Again, get with your CPA. They'll probably tell you, here's a chart. So how do you avoid the pitfalls? So everyone wants to overcomplicate it, right? So we just talked about that. The myth is it's complicated. Investing requires knowledge I don't have. Well, get a real estate broker who has experience, right? They'll help guide you through it. Investing is risky. Well, it can be if you're not doing your homework and your due diligence, like Ryan said, or you don't have a team, an attorney, a CPA, a real estate agent, a real estate broker, a mortgage banker, or someone that is going to lend money for you. Truth, investing is simple when you learn the fundamentals. We're doing that today. Successful investors invest in what they know. Stick to the one thing you know. I like certain investments. I don't go outside of my lane. Follow sound investment principles. And we've talked a lot about that. So successful investors time the market. This is a myth. All good investments are taken, right? There's none left. There's nothing for me. It's too much work to manage properties. Truth, establish clear investment criteria and stick to it. Don't overlook personal reasons for buying and selling, okay? Stick to the numbers. Leverage, so like when you ask that question, how do they know? If they have a better investment and they want to move on to that. Leverage property management systems. Okay, so this is a great chart. Invest, don't speculate. Obviously, collector versus speculator. I see a lot of speculators out there right now, and it's very high risk, high return. Collectors are more low risk, low return, and that would be someone that buys and holds. And then you have minimum risk, maximum return over here with the investor versus the observer who sits back and does nothing, no return, inaction. So these are common mistakes: speculation, they didn't run their numbers; insufficient reserves, they don't take that into account; or unsure to actually how to calculate a true return on the investment, which we've walked through for the most part. Okay, so let's go back to building a team. So you want an agent or a broker, a lender, a property manager, an attorney, a CPA, and then you are the investor in the middle. So you want knowledgeable, best at what they do, and reliable. A lot of times your agent might know, or your attorney or your CPA might already work with another real estate attorney, because a lot of times you're going to your attorney to figure out how to set up your entity first, and then, or your CPA and then your attorney, that order. So they might be able to refer you someone. Okay, so this probably looks familiar to some of you that are agents. We kind of call this our sphere, and we have an inner circle, support circle, and service circle. This would be like our strategic alliance partners, we call them. So you have your consultants, your mentors, and your partners. I had several great mentors when I started, who helped me get into real estate and helping others. I just wish they would have told me, you need to invest right now. And I didn't really, I was too busy helping my clients, but that's great. It all worked out. Then you have your support circles. That's your property managers, your lenders, your investors, your accountants, contractors, and then your service circle. A lot of people forget the courthouse clerks. That's where you're going to find a lot of information. So I used to go down there physically when I first started real estate. Now there's a lot of stuff online, so you guys are a little spoiled in my opinion, but it was a lot of fun going down there and making friends. Landscapers, title companies, cleaning services. You guys know I've partnered with one of my friends who has a cleaning company. We refer business back and forth. Great resource. Especially she'll say, boy, I had to clean up this property. Looks like a good investment. And she's also licensed, so she can see it. So you stay connected to your network. Your inner circle, it's once a month. You want to stay in touch with them. Your support circle, it's every single transaction. Your service circle would be as needed. So, and when we're talking about our sphere in real estate, when we're selling, this is kind of like your core of your database, the ones that refer you a lot of business that you do a lot for, and they do a lot for you because you have a great partnership, and then maybe your strategic alliance partners on the outside. Confirm your investment criteria. So Megan, we kind of went through this. I think this is something you can do with your realtor, so we'll whiz through it. Basically, what can you afford? Tony's going to get into that. We've already talked about return on investment. Cash flow are you looking for? What is the appropriate acquisition strategy based on your finances? Tony's going to help you with that. Property type, single family or multifamily, location, your realtor can really guide you, condition, and then features. These are examples. Maybe you want a net cash flow of $200 per month, and you want to buy and hold homes with 10% below market value as your purchase, what to take off the purchase price, and then 20% down. Maybe you choose a single family home, certain neighborhood, little to no sweat equity, and then you want brick. Here, that would be like a concrete block, maybe 3-2 with a pool. I always like a pool. We've already seen this side, so those are your options. Again, I like buy and hold. And then so your circumstances. Don't own a home, little or no money, so you want to buy and live. Have money to invest, looking for cash, buy and sell. Have money to invest, you're looking to build wealth, and that's when you buy and hold. Okay, so you're practice analyzing deals. I'm going to give you some different ways to figure out, is it a deal or no deal? You have your criteria, you have your mortgage, you have your rental income, you have your expenses, you have net operating income, net cash flow, you have a cap rate, and then you have a cash on cash return. A lot of people don't know how to calculate that, so we're going to get into that a little bit. And then you have your total return on investment. Okay, so that's different than your cash on cash return. Here's some criteria. So you might want to know what things are renting for. These are basic numbers. So if you're looking in just a general subdivision and a general zip code, and there's nothing really, fancy about it, there's no water access, or it's not like a prime location, but it is a 2-car garage, and maybe it's in Northport in a neighborhood where a lot of people want to live because there's a school nearby. Here you go. You can find the zip code. You can see, according to HUD's website, what kind of rent you can get based on efficiency up to a 4-bedroom. Now, again, get with your real estate broker. They're going to be able to do a little bit more of an analysis. This is basic information. So you can pull up any zip code. So how are you going to find these investments? Okay, this is the fun part. This is the gold mining, the digging for gold. Networking. Number one thing, if you're a people person or someone on your team, this is how you can do it. You can leverage existing relationships to find potential properties. This is your sphere, people you know. You're going to drive target markets, looking for sales, signs, vacancies, anything that's unkept that you drive by. You want to go back and research that property, pull up your software, try to find the phone number. You're going to send them a letter. And there's a specific way I can teach you how to write the letter. That might be in our 102 investment seminar. Market, comprise a campaign, including flyers, online, and print ads to spread your message. You could do a Facebook ad. Now, if they're in pre-foreclosure, you do need to be sensitive to the topic, okay? A lot of times they are gonna wanna wait to the last minute to, unfortunately, realize the situation. You wanna be sensitive. So some of the scripts you might use are, if I were to bring you a price on your house right now that you felt was fair, would you sell your home? Don't call them. And I think Christina Griffin said this today in a pre-foreclosure webinar on MAPS coaching. Don't call them and say, I know you haven't been making your mortgage payment. They already feel bad enough. This is a hard time. Help them get into a rental. Help them with some credit repair options over the next, and maybe they can get into another home later. Seminars, friends and family, neighborhood associations are great. They know all the skinny on what's going on. Business colleagues, community events, obviously real estate agents, that's us. Lenders, Tony. Attorneys, it's Ryan. Real estate investment clubs. There are really cool investment clubs you can get involved in. I know our home inspector's in one. So I'm always like, hey, if there's an investment you don't like in there and you see, can you let me know? Because I would love to know about it. And so he's got his eyes and ears open for a Northport commercial building for me right now. All right, so you're going to prospect for listings, vacancies, for sale by owners, pre-foreclosures or foreclosures. I love pre-foreclosures and foreclosures. I'm going to be laser focused on this, especially with forbearance. This is not predatory. I am not taking advantage of people. There's a way that you do it where you can help them get back on track. And I feel we have an obligation.
And something that's really wonderful, if we can save them from being foreclosed on,
Absolutely.
Then they're that much closer to being able to purchase a property again in the near future.
That's right.
You're in the right position.
So a radio show called me the other day. I said, I will go on the show if we can talk about the reality of what's going on, because nobody wants to talk about it. Everyone wants to say how great the market is. The inventory is low. We do have multiple offers under 400,000. There are a lot of great opportunities, but there are also people that are going to suffer from this COVID. We have to be there to help them and stop pretending like it doesn't exist. It bothers me when real estate agents are like, oh, the market's great. It is great. There's a lot of great things going on. But there's also an area of the market you always have to say, this needs help. And you have to be there to help all people. Create billboards, yard signs, direct mail, radio or TV ads. That's something I talked to a radio person about yesterday. So we'll see if they want me to go on there and talk about the reality. Finance and buy. Okay, so we have Tony who's going to help walk us through this part. Obviously, you want to understand the steps involved in financing, purchase, and the transaction process. You want to arrange financing, okay? And you want to write a bulletproof offer. I know some of my team members can talk about this. Negotiate and win a win-win transaction. I can touch on that. So Tony, you are up, buddy.
Hey there.
How are you?
Can you hear me?
I can hear you.
Good. Hang on a second. Let me get to the screen. Do you have a screen for me, or is this just a wing it? I'm just kidding.
I have a screen up for you. Can you see my screen?
Yep. Let me look at it. Hang on a second.
This is all basic knowledge for you, buddy.
Oh yeah. You know me. All right. So I got a couple of good takes on what I've learned from investing from just watching people do things that a lot of people don't know that you can do. Um, so do you guys, so conventional loans, this screen, we're talking about conventional lending. We've got government loans, we've got conventional loans. I will actually put myself on video here too, so you can see me.
There you are.
All right, so you've got conventional loans, sorry, getting to, the end of the day is when I get all of my messages from processing. So
oh, I'm sorry.
No, it's okay. It's okay. No, I'm good. So the difference between a conventional and a FHA, to be honest, the difference is that, with conventional loans, that if you put less than 20% down, your mortgage insurance will fall off eventually at 22% loan to value. So while both of them have mortgage insurance, FHA, conventional, both of them have mortgage insurance, you can't use government loans for investment, right? So when it comes to investment properties and you're buying specifically for the purpose of investing a property, you can't use it. If you're buying a second home, you can't use it, right? So what's super important to note though, is that there are some really cool tricks to use, right? So when, if you guys are working with new buyers, and this is what's really important, so many people, they think that they're buying their forever home, and it's not. We always know it's not their forever home, but they're looking for their forever home. And if we can get their head wrapped around what you guys are doing here, right? Wrapped around becoming investors, savvy investors, and having these clients forever, right? If we can wrap their heads around it, what we can do is we can teach them to use their homes as departure properties. And what that really means is, hey, think about this. Like, you go into a duplex, FHA duplex, you only ever need 3.5% down, okay? 3.5% down in an FHA duplex, your max loan amount's like $600,000, right? A lot of people don't realize that.
I love this.
So you can go buy that at 3.5% down, live in it for a year, rent out the other side, pay your mortgage.
Yeah.
And then you can depart from that residence with a 5% down loan to get your next primary. You can offset your current residence of a departure residence with just having a lease and a deposit for that property when you leave. So at closing, you've got someone coming in to backfill you. We can take 70% of that amount and put it towards your debt to income. So people don't realize that. And a lot of agents just want to sell their other house. They just want to sell their other house. And I get it. Like, no, let's sell it. No, let's sell it. If you guys want to have long-term clients, I think sometimes you teach them the power of leapfrogging into homes and not putting 20% down. Right? So, I mean, think about this. You get into a $400,000, $500,000 duplex right now, it's 3.5% down.
It's insane.
And you're going to rent out the other side. It's paying half your mortgage. Now, what's cool is that you can use your departure residence every time, and every time you depart from one, you can get a backfilled lease. So you can literally, now you can only have the one FHA loan. You can choose in a year to go refinance that into conventional and go get another FHA loan on another duplex. That's okay, right? But you can also just go get a conventional loan at 5% on the next one and get a regular single family, because a duplex is going to be a different loan to value. You can't put 5% down on a duplex. Conventional lending, you have to put, it's a 15% for a duplex for primary, and it's 25 for investment. So when you buy duplexes, you're gonna have to put more down, but that FHA has that beautiful sweet spot,
Yeah.
So when you teach them how to leapfrog into the next home and use that, then you also teach them to go get a really good accountant who develops that Schedule E. And once you have a Schedule E in place, and you've had a Schedule E for 2 years that you've developed rental history, now not only can you go put 15% down minimum investment on an investment property, which people think it's 20, but it's 15. You can put 15% down. You're still paying mortgage insurance, but oftentimes the rent is still going to outweigh what you're doing, right? And what's really cool is once you have that, you can then, once you have the Schedule E for 2 years, we can do something on an appraisal for that new investment property that's called a rent schedule. And we've proven that you have rental ability, you have rented for 2 years. Now we can take the rent schedule, and the appraiser goes out and says, this is worth $2,400 a month. They put that on the appraisal, on the rent schedule. It costs a little bit more money. It's like $750 for an appraisal with a rent schedule. But then we can take that $2,400, we can take 70% of that and offset that DTI, so that people don't need to make buku dollars if they're doing it right. They can just stay and offset their debt to income every time, even if they're writing every penny of that investment property off.
Yeah, and
So,
that's what we're talking about doing. So we've got to have, again, a team. You've got to have your accountant or your CPA, your attorney, and then someone like Tony, and then an agent, right? All
Right.
helping this person set up their future of building net worth through real estate. And it's so important in the beginning. And you're right, there's so many agents that, they just want to sell the property and go sell them something else instead of that long-term relationship. If they are building net worth and you've changed the entire trajectory and the future of their family or their building family by helping them with that first investment that turns into a second or a third, you change their whole world.
or 15.
How many people do you think they will refer to you to do the same thing? You've got to look at the big picture of being a servant leader and setting people up for success for their family, and just pour into the people, and they're going to pour back into you.
So, and exactly. And then back to the conventional slide, right? So it says previous landlord experience. That's that whole 2 years that you develop while you're leapfrogging 2 homes, right? And in 2 years, you can put 3.5% down for the first year on the first one, 5% down on the second year for the second one. And then by 2 years, it might take you 2.5 years to actually have 2 years of tax returns.
Sure.
But now you have 2 years of tax returns, and now you are a proven landlord. And now you can use
previous landlord experience. That was the next thing on there.
That's right. So, and then you do have to start getting the cash reserves. But as you grow, obviously, that cash reserves gets easier as you start having this income come in.
Well, and you need some reserves in case you have some maintenance. So, that comes along.
They need cash reserves sometimes to approve investment properties, depending upon how many you have and everything too.
Absolutely. Yeah. They want to make sure, just like with any business, right? I mean, I'm not pulling a profit out of a business unless I have reserves, especially right now. Right. I mean, that makes no sense. So we have to help them. This is a business, right, that they're going to own, which is investing in real estate. Okay. So our next slide is just talking about private financing. Obviously, if they can't get approved, there's some hard money loans or some partnership. There's some local banks, some syndications you can go to. But, for the most part, I think as long as you're setting them up right and you have that buyer consultation, I feel like you can get them set up for financing with the traditional way.
100%.
There's also creative financing, like owner financing, assumptions, wraps. I did a lease option on my first commercial, private seconds. There's all kinds of creative ways. So if you've explored all your options and for whatever reason it's just not working with Tony or another contact you have, these are some strategies that we can help explore for you. So the difference, okay, and these, I hope Tony stay on for a few minutes if you can. Answer a couple calls and we'll be calling you back.
I'm on.
Okay. So conventional loans, how much will my monthly PMI be if I'm securing a second home, or securing owner occupied financing and putting less than 20% down? How long is the term of the occupancy for owner occupied financing? These are just questions. What is the current limit on number of properties for a conforming loan?
20.
Okay. All right. Well, you answer as we go.
Yep. PMI is not terrible when you're putting 15% down. It's not terrible.
Yeah, I'm not opposed to it. And I think I think it's all in how.
You can also buy it out.
Yeah. Can you talk about that, please? Because I know that you brought that up was it you, Megan, on the team that had a question, or was it Bria or someone had a question about that?
I do that a lot with people putting 20% down. Now, It's a little bit different on an investment property because investment property, so on a primary occupancy, 15% down is actually a better interest rate than 20% down.
Okay.
And people don't realize that because at 20% down, you do not have mortgage insurance. But at 15% down, even if it's $60 a month, you have mortgage insurance, which makes the loan less risky. So
Got
because
it.
the loan's less risky, you have a better interest rate. So it could be an 1/8% difference or a 1/4 point in points for the rate. But you could potentially, I did, so primary occupancy, $200,000 loan amount. I think I just priced one out for it was a 300,000, 360,000 loan amount, primary occupancy, 15% down. They could buy out, they could either pay $76 a month or buy out their mortgage insurance for $2,400.
Got
You
it.
never have to refi. You never have to worry about when it falls off. You have it, and you just paid it up front. So you just have to decide how long you're going to have the house, whether
Mhm.
it's worth paying it up front or whether it's just, you pay it monthly. So,
Well,
but your
and
interest
I
rate
think,
saves money too, on that. Now,
yeah,
on investment
yeah,
property, interest is a little bit higher at 15 than 20.
yeah.
So it's a little bit harder, but you can get rid of it as well, and you can buy it out, and it's a lot more expensive. But second home primary, it's a really great way to go.
Yeah, and a lot of times, what we're doing, like you said earlier, Tony, is we're setting them up with their first house with the intention of this might not be your forever home. We're getting you into investing in yourself and investing in real estate with the anticipation that you're either going to rent that house out later, or maybe you're going to keep it for 2 years and then you're going to sell it and use that money for an investment property on a down payment. I mean, it depends. We always do a consultation with them, and we talk about, and we're talking about this today on role play and script practice of what are your dreams? What if you could have any property ever, what does that look like? And if it's like some big house on the water, well, that's great. Maybe we need to buy some investment properties to get you there. That doesn't really impress me much because I don't want a big house, but I'd rather have commercial buildings, or I want, triple net leases. So that kind of works me up a little bit more than that big house, but everybody's different. So how do we get them to what they want? And if it is that house on the water, or it's, they're just starting out, how can we help you get there? What, and why does that matter to you? Might not make sense to me, but why does it matter to them? And then they might self-discover, well, yeah, I actually do want some commercial or some residential, investment property. And then that's when this whole conversation comes out. So obviously you have conventional loans, you have some FHA options that most of the people on the call probably didn't know about, and hopefully our audience, so they can contact Tony. We have private financing. We talked about creative financing. So basically, we need to learn strategies for bulletproofing your offer. All right, so this is where some of our team members can come into play. How much equity does the seller have in the property, right? So you want to learn the seller's needs and motivation. Why is the seller moving and when? There are so many times when we talk to another agent, I'm not sure they should be telling as much information as they do, but we're single agents unless we are a transaction broker with a buyer on our own listing or a listing within our brokerage. That very rarely happens. So a lot of times we get to be a single agent with fiduciary duties. So how many times have some of you on the call called another agent and they give us all this information? What terms will they accept?
All the time.
And you're like, boy, I'm so glad you're not my agent.
Oh, I bet if you offer this, like, I can definitely get that accepted. Like, oh, great. Thanks for telling me they're desperate and I could save my clients $100,000.
It's unbelievable. So yeah, having a great agent represent you. And a lot of times if I call, even for an agent in my office, like, I've built up so much rapport. I don't even know why they're telling me so much, but they're giving me so much ammunition. And I'm like, thank you. I just sit there and listen. I'm like, how much more? Let me get my notepad. How much are you going to tell me? I've already researched the property and gotten all the information, but the more you can tell me, the more I have to, write up a great offer. So name a competitive price, obtain a comparative market analysis. That's what we do for our clients. What are comparable properties selling for? Comparable prices and quality of other properties with the property of interest. We know our market, so we're constantly looking at inventory. I mean, some investors will call me and I'll be driving and I'm not even on my computer. They're like, what do you think about this price on this property? Nope, too much. If you can't get it for this, don't buy it. And then boom, they hang up and call me back. Nope, they wouldn't sell it for that. Well, let's wait 6 weeks. Let's see how desperate they get. Compare prices and quality of other properties, property of interest. We talked about that. Know your terms. What requests can you make of the seller to sweeten the deal without lowering the purchase price? So maybe it's a home warranty. One of our agents in our office just is negotiating a deal. They gave him a credit for repair. It was a very big repair. Quite honestly, I feel like there were some disclosure issues, but we're not going to go there right now. Pretty big ticket item. If you know real estate, you know what I'm talking about. And it came up in the inspection and the seller immediately decided we would go ahead and credit or repair or whatever, the credit. Well, then the buyer wanted some more repairs. Well, they already had the big ticket items. So the agent was very creative and said, let's just do a home warranty so we can make this easy. So now that's where they're at. Maybe if you're contributing closing costs, like contribution to closing costs. Megan, can you chat on that like a little bit, like when you write up an offer?
Yes, definitely. And it really depends on the type of financing your client is using as to how much you can ask from the seller for a seller credit. So if it's an FHA, they can ask for up to 6% of the purchase price. And if it's a conventional loan, they can ask for up to 3%. So it's important to know that so that you know what you have, what ability you have to negotiate that. Also, there's, definitely get either your real estate attorney involved or your preferred lender so that you know the right verbiage, because that can be an issue. You don't want to say, 3% for, and list specific things, because let's say those things don't add up to the amount you're requesting. Well, where's the rest of that money going to go? It's going to cause red flags for you in lending. So just make sure you're asking people who know the ropes, write that and structure that offer the right way.
And when I'm representing a seller, I'm going to have specific language I'm going to go back with if they did not specify if it was title and the 3, because I don't want to get stuck with the 3% plus my seller paying title. So it depends on who you're representing as a single agent in our case.
Absolutely.
And also that's something you want to ask your agent. Are you going to represent me as a single agent? Because we have fiduciary duties. And so we can send you the Florida statutes on that. Transaction brokers are facilitating the transaction. We can send you the differences. It's very important.
And if an agent's not having this conversation with you about single agency versus transaction broker, then they are assumed to be a transaction broker.
In the state of Florida, that's correct. Okay, so finance and buy, negotiate everything. Price, financing costs, closing costs, possession date, conveyances, ability to rent prior to close, ability to start repairs before closing, and ability to assign the contract. So we had talked about different entities. Maybe you're not set up as an entity yet, as an LLC, or maybe you want to form a trust for some tax purposes. You really, really want to make sure you can assign the contracts. It's very important to have these questions. You don't want to get to the closing table and poor Ryan goes, your client just called and they wanted to be an LLC. You didn't give me this information. Who set this up? Oh, so-and-so attorney in New York. Oops, didn't, there's communication involved with your team, and that all starts with your buyer consultation. Okay, so here's Tony's information. This is how you can contact him. His bio, he is a former firefighter. Tony uses skills he developed on the job, problem solving and effective communication. That's so important when you're building a team to help customers overcome obstacles as they travel the path to homeownership. He especially enjoys giving back to public servants, veterans, first responders, teachers, and nurses by going the extra mile to help them achieve their home buying goals. Here's a quote. I love that people trust me with the biggest purchase of their life, he says. I take on challenges big and small, and I don't believe in giving up. I keep working until my customers have realized their dreams of homeownership. And like we were just talking, it's not just this one purchase. It can be obviously more to it. Tony is also a certified fellow John Maxwell coach, and his passion is encouraging and mentoring others, both personally and professionally. In fact, his proudest professional moments are when former firefighter students contact him to help with their home purchase. It means a lot to him that he can be part of other people's lives and happiness. He is also the proud father of 2 sons, keeps busy away from the office as well. He loves spending time with his family, engaging in his other passion, the water, especially boating, diving, and fishing. So here's how you can contact Tony Fitzgerald. He has a lending team with AmeriFirst Home Mortgage.
Hey, I wanted to bring something up real quick. Here's a question for everybody. Who knows what the maximum seller contribution on a Fannie Mae mortgage is for an investment property?
Uh-oh, Megan, do you know this?
Oh, I don't know this one. I knew
She
those
was just
two.
rattling off all of her knowledge, so I don't know.
I actually learned both of those from Tony Fitzgerald, and I typed him in the middle of the evening, like, "Hey, question for you."
Yes, and by the way, guys, you all know that you can just text me anytime, and I always answer you guys.
And there's never a silly question. Like if you are not asking questions, you're not learning and you're not growing.
I mean, I might roll my eyes, but not often.
No, you won't. No, you won't. I know better.
So the answer is 2%.
Right.
Oh,
So it's good to know because everyone's stuck on a 3. It's 2%, any investment property, any LTV. Do you know what the maximum seller contributions is on a Fannie Mae loan? Now, I'm not going to give what's the maximum on a Fannie Mae loan for a primary or second home? Do you know?
No, Megan?
So would that be like an FHA loan?
Nope. So on a Fannie Mae,
Fannie
regular
Mae.
loan, conventional
Regular loan. Conventional Fannie Mae.
3% for conventional.
So partly correct. So at anything less than 5%, okay, anything less than 5% down, or 95% loan to value. Okay, it is, or sorry, anything less than 90% loan to value is 3%. Anything between 90 and 75%, you can actually get 6% seller credit. And anything over 75% loan to value, you can go as high as a 9% seller credit.
You know, Megan's not just thinking for her clients right now. I know this. She's like, wait.
Now, of course, the market's got to handle the credit between the appraisal.
Of course. Yeah.
But just
point.
a lot of people don't know that you can do that.
That's a great point. So, okay, let's say you find your investment. We're going to wrap up here. I know we're all getting like evening ready to have dinner. It's 5:45. I don't think we're going to have too many questions because we've covered so much. We can always answer those on Facebook later when we do our recording on there. Manage like approach. So you're going to set the rent. You need rental comps, okay? And you want to make sure you can project your rental, your projected rental income, which is also competitive. Promote your property. So with us, we have a management software program with our company that, kind of like with our real estate company, will syndicate to more than just what the MLS syndicates to. So in our brokerage, we go to over 1,000 sites internationally. We have a similar software, but on the rental side. So, you know, sticking it on the line as a for sale by owner or just going on to a regular rental site is probably not going to cut it. Then you need to screen the tenants. If you are not getting 3 or 4 applications, your rent's probably not right. You want to be able to pick and choose your tenants, okay? Most of the properties I've rented, even my personal ones, I've had 3 or 4 applications. That means it's priced right. That means you can pick and choose your tenant. And sometimes I get 2-year tenants. I have one that has a 2-year lease, which is fantastic. Okay, so what's the process to ensure a smooth lease transaction? Okay, you're going to have someone that shows the property, unless you want to manage it yourself. These are all the things you have to do if you manage it yourself. Get prospect contact information, schedule showing, process application, which you can do online right now. It's pretty easy. Have prospect complete that. Collect application processing fee. You do want to charge a fee of around $100. The reason is you want to show, like, are they willing to spend at least something like that to process the application. You're going to get pay stubs, driver's license, tax returns, financial statement, if required, by the landlord or the person you're managing the property for. So once you screen it, you have a credit report and you can review that with the owner. You want to call to verify the employment, especially right now. Call to verify previous rental history with landlords, if applicable, if they've rented before. Then you review that tenant application, whether or not it's approved, or notify of denial. Send applicant application denial letter, unfortunately, sometimes in some cases, and then file that away. Review the lease if you move them to the next step. Sign the lease. Now, sometimes you are going to have, we use an attorney written lease. Ryan has done all of our leases for us. That was on the call. So if you are an investor and you do not have a good lease, you want to hire an attorney to have a lease you're going to use for your clients. Same thing with a property management agreement. Sign the lease and collect deposits, inform tenant of approval, set up lease signing, prepare the lease, have tenant sign the lease and collect cashier's check, money deposits, send completed lease. They're going to move in. You need to do a walkthrough with them, give them the keys, take pictures, give them an information package of all the utilities, inspect the property, update property files, and then they're typically going to switch over the utilities. But if you are paying the utilities and there's something that the landlord's paying, you might be in charge of that as a property manager. Okay, so, and then you have systems, you know, obviously you need to coordinate repairs. If there's a problem, is there a warranty? Then you notify the company. You're going to collect at least 3 vendor bids, fill out the vendor selection. We have a repair and remodel company, so we actually have our property management company contact our repair and remodel company, and then it's just very smooth and easy. Then you want to follow up to make sure the work's complete, approve, and then it gets paid. So if you're a landlord, you don't have to do any of this. It's all taken care of. The tenant's not calling you. Then the process when they move out is that 30-day notification. Then you're going to do the walkthrough. Then you obviously want to get it back on the market. You need to pull comps, all the correspondence from the tenant and the landlord. You need to have that on file. You'll have a walkthrough inspection form. Everyone needs to sign, kind of like when you sell a property, Megan. Pull rental comps to verify price point. Call the utility company to switch everything back to landlord until you get a new tenant. And then you're going to start that whole new advertising process. And then, you know, that could be MLS, all those thousands of websites. Walk through inspection schedule by tenant when they move in. Again, you're starting over, get the keys, move in, move out, kind of order the cleaning, make sure all the repairs. Sometimes there's a lot of repairs when they move out. Paint, you know, cleaning, things of that nature. Then you want to update your database. So then you want to increase gross rental income when you need to maximize your net operating income. You want to control your expenses. It's very, very important. And minimize vacancies. So that's why a lot of people do choose a property management company, because they don't have time to, you know, go ahead and replace their tenant back to back.
Especially if they've got multiple properties.
Or they're out of the area. A lot of ours are out of the area.
So true.
So you want to maximize your deductions. We already talked about depreciation, operating expenses, insurance, home office, services, travel, and losses. Okay. So you have, know your options for property disposition. So you had this question, Megan, how do they know? Well, they might want to do a lease option out. They might want to refinance to get money out. They might do a tax deferred 1031 exchange or the option of selling. It will be our job as a professional consultant to walk through these different options, and then they decide, but they're going to have a lot of questions for us. So growing your portfolio, you're going to buy fixer-uppers, make improvements, invest out of state in strong growth areas. We'll get into some of those areas. Buy foreclosures, short sells, buy investments with a self-directed IRA. I don't really like doing that, but some people do. Turn necessary expenses into gains, tap your equity, and repurpose existing properties. This is our property management. We can send you information. We now have 2, one down south and one in Sarasota, Manatee County. A lot of times we have seasonal property manager property managers that are separate from annual. It's a very different market. Then do you want to stage your seasonal? Obviously, you know, for selling or for renting a seasonal property, it makes a big difference. We can send you some National Association statistics on that. And why to stage? This is actually a property that we have a contract on right now. So it certainly helped with that. This we've already talked about. We're just going to cruise through. We've already done that. Okay, so are people coming here? We're going to go through statistics and then we'll be done probably around 6 here. Personal financial characteristics of buyers. Why are they coming here? A lot of them you can see are vacation property owners. So we have 86% are looking for vacation properties. Now, again, this is National Association of Realtors. Most people are looking for that versus a primary home, and they feel like it's a good time to purchase. Buying another property, you can see investment property, very likely 28%, somewhat likely is 39%. Same thing with vacation, 23% and 31%. So you can see people are going to buy another property in the next 2 years. So are you going to be their consultant? Is basically the question. Or are you going to be the person buying out there? I mean, are you looking? Here we are. We're ready to help. We're likely going to, huh?
I said both.
Right? And then likely, so that's investment property, and then you can see vacation property. And then over here, short-term rental experience. Some people just don't have the experience, and it tells you who's tried and who hasn't tried to rent. That's a very different, like I said, version of property management. And we have a manager specific for that, just so you know, if you're looking to refer. motivation for purchase, this is really interesting. Vacation, personal family retreat, 42% versus 9% for investment. So we get calls all the time and they say, well, we want an investment property in Florida. Okay, well, let's talk through this, because a lot of times it's not really investment property, it's a vacation property, and those are two different things. So they're not looking for something that's really going to cash flow. It's something that might help absorb their expenses of their vacation property. We can help you with that too. Very, very popular. All right, so this is financing. You can see used a mortgage, pretty much primary vacation investment. Everyone's leveraging. I mean, the interest rates are low. What can I say? Distressed, you can see not too prevalent, but I think we'll see some more when we watch the up and coming statistics. This is interesting. Look at on that. You can see we don't have a lot of distressed sales right now. Okay, with townhomes, single family, there were only 1 in May that closed as a short sale. 15 foreclosures. We're going to watch those numbers for more opportunities. Okay, so why Florida as we wrap up? Why would you invest in Florida? Okay, well, look at the population growth. This is really important to understand as a real estate professional consultant, as an investor. Our growth, you can see here from 1980 to 2019. Look at that growth on this graph here. Fastest growing metros from 2010 to 2018. Okay, you can see the Villages at 38%. This is kind of a sister area to us, Fort Myers. Now jump down to our MSA. We're number 25 in the USA for Northport, Sarasota, and Bradenton. So do you think that might be a good investment opportunity area? 17% population growth. People are coming. Might be able to rent your house out. Then what about employment? Everyone's talking about unemployment. What's going on? Well, we'll see what happens, but I can tell you right now, from 2010 to 2018, Florida was number 1 in the country, okay, for jobs and percent increase in employment growth, 22.4% for Florida. Texas following second. Okay, so population growth, you can see we're up there, 13%. Texas did beat us out on that, top 10 by number of people.
How interesting, though, that Texas and Florida are both no state income tax states.
Do you find that to be an interesting trend, Megan? Who knew? Okay, so top 10 outperforming markets. Metro areas, National Association of Realtors expects home price appreciation to outpace in the next 3 to 5 years. By the way, this is all on a recorded conference. So if you're a realtor or you're an investor, get with a realtor that understands this stuff and is following the webinars. I'm sorry that we're not able to travel and be in person and write off our fun trips, but we are still on webinars. The ones that want to be in front of the market and know what's going on. So metro areas that NAR expects home price appreciation to outpace in the next 3 years. What do you see there? See anything that stands out? Florida, Tampa, St. Pete area. This is our area. We're right there. So top 10 outperforming markets. Okay. That's another graph. We can skip through that. Okay, so this is more into commercial. You can see a demand for apartment complexes exceeds even the high level of new supply. That's been in demand. I think we've seen new apartment complexes being built in our area left and right. So if you're a realtor and you're not noticing that, you're sleeping. Rent growth has slowed except apartments. So you can see, you can see a percentage change on this graph here. Industrial's not doing too bad itself. So surprise, commercial real estate market's got a second win in 2019. You can kind of see a jump, okay, a spike up here, another dip, and then back up. Okay, so why Florida? So Megan, this is gonna be a topic that you just brought up.
Yeah.
So Florida ranks top state to invest. This is according to rent.com. This was a few years back, but I feel it's very relevant. There's different areas you can see that we had on the new study at rented.com ranked the top 150 tourist cities by their availability to rent out a vacation home. And the 150 cities surveyed, Florida claimed first place with 19 spots based on their ability to provide rental returns to investors. So that's the brief summation of that. 1031 exchange, basically simply put, okay, if a client asks you, this is on my website, this is also on my property management website. If you are a client and you're thinking about doing a 1031 exchange, or maybe you're right in the middle of one, I've got 2 clients that are looking to exchange. Simply put, okay, this is right from IRS. A 1031 tax exchange is a way to preserve capital and utilize that capital to purchase another like kind investment property or properties. Not so simply put, the term 1031 exchange actually refers to the section 1031 of the Internal Revenue Code, okay? This section of the IRS tax code allows for an exemption of capital gains taxes whenever you sell an investment property or a business-related property. The caveat, you have to reinvest your gains or proceeds back into a similar property, what is called a like-kind exchange. So what the heck is like-kind? And then it goes in to kind of tell you. So again, get with your CPA. There's going to be an intermediary. There's a process. Get with your real estate broker, your attorney, your team. So we talked about this on book club if you're an agent, but if you're an investor and you haven't heard of opportunity funds, it's quickly becoming a discussion of topic in Sarasota. There's an area in which there are some really nice advantages. So basically, in the simplest terms, the government is providing tax breaks and incentives to investors to exchange for providing much needed capital to low income areas. So when people say, well, you're not paying your taxes, you know, you have all these deductions or benefits, and, you know, the wealthy should be paying their taxes. Well, if the government's telling us they want us to go and help build good housing or buy investments in these opportunity zones, obviously it's what they want, and they're offering us tax benefits and incentives. So we as investors are going to do so. So the government's asking us to do it. What's great, tells you right here, any gains are permanently shielded from taxes if the investment has been in the opportunity fund for 10 years. Maybe you don't want to keep it in the fund for 10 years, then there's like a 90% for holdings into, you know, partnership interests and things like that. So totally depends on how long, like you said, Megan. Those are some of the factors that investors are going to consider when they're looking to make another investment. Well, can I shift over here and then protect it, and I'm going to invest in this for 10 years? Again, these things are going to help determine how long they hold a property. Now, 7 years, the initial investment, we discounted up to 15%. So maybe they don't want to keep it there for 10 years. So most of you have seen this if you have been following the news. This is Bloomberg's article on analysis of migration, and it's all according to the U.S. Census Bureau. Bloomberg's analysis include all 50 states, okay? And it's the nation's capital to provide a fuller picture of aggregate income flows from migration. About 10% of the population moves annually, or about 35 million people, okay? So where are they moving? Florida's powerhouse economy continues to churn out new jobs, like we just talked about. Retiree migration to Florida is on the rise, and the millennials are coming into their prime home buying years, okay? So we've got so many different buyers, so many opportunities. What's really cool is you see over here, I don't really like talking about losers. Let's talk about the winners. We are the winner by far, 17.2 billion, okay? Right here, look at this. Coming into Florida. Florida ranked interstate migration as the top money magnet. So we are attracting the money. So Florida was the top financial magnet, reeling in 17.2 billion, more than it lost, about 7 times the amount netted by each of the runners up. That's a huge number. New York was the biggest loser. So we have a lot of people coming here. Sorry, New York, but maybe thank you, New York, or maybe congratulations because you're coming here. So this is another in and out graph that you can share with your clients. That's where the methodology came from. And then key takeaways: know why you're investing, track your net worth, analyze many properties, join your local investor association. And then if you like some of these resources, I can send you the personal budget worksheet to get started, your criteria worksheet, your COR worksheet, your buy and sell worksheet if you want to flip, and your buy and hold, which I love. And then you can do a 30-year analysis versus a 15-year analysis on those investments. If you'd like to find those yourself, you can go to kellerinc.com resources, and here's an evaluation if you'd like to evaluate us. That's it.
Awesome. Well, I would like to thank so much, Brandy, for sharing so much knowledge with us, your experience. I personally learn a lot every time I'm around you, and I can't wait for so many more people to watch this as well, so that we can start helping them change their futures.
Yeah, well, we recorded it, so obviously they can watch it in little increments. That's what I do when I can't watch a lengthy. I mean, we were on for 2 hours, but we wanted to cover from start to finish, and hopefully it helps some people, and we'll go from there. We'll get some questions. I hope. I'm sure. I hope.
Yes, definitely.
Thank you all for attending. Hopefully you learned something and had some good takeaways.
All right. Take care, everybody.
Bye.